今日は、マイクロストラテジーのビットコインのイールドや、将来ね、マイクロストラテジーの株価がナスダック100、Qqq にね、入ったことによる影響っていうのをね、話していきたいなと思います。この動画では3つのね、形で株価に影響を与えるお金のフローね、初期フロー、パッシブフロー、リバランスフローっていうのを紹介した後に、このポッドキャストインタビューされているので、それをね、翻訳したものを、残りのね、7割ぐらいずっと翻訳したまま、聞いてもらえればなと。興味がある方はぜひ見てください。ということで、インデックスファンド、ナスダック100はアメリカの非金融セクターのトップ100企業が追跡するインデックスで、アップル、マイクロソフトのようなキュラー企業も多く含まれている。このインデックスにマイクロストラテジーが入ったことによって、初期フローとはナスダック100への追加時に ETF がマイクロストラテジーを購入するために資金が流入すると。ということで、初期フローはおそらく21億ドルに達する見込みであると。これものすごい金額でちょっとよくわかんないけども、要は、上場時にさ、コインベースとかさ、ビンビンファーストとかさ、みんな株価大上昇するじゃん。ね、WeWork も。で、その後爆下げしちゃうじゃん。その上場時の、ね、爆誕、なんだ、おめでとう上げが初期フローのこと言ってるのね。次、パッシブフローなんだけども、アメリカの IRA とか 401k って、日本で年金機構のさ、年金の積立金みたいなやつですね。で、これ税制的にね、優遇されてるわけよ。キャピタルゲインをね、利確するまでね、将来先延ばしますよ、みたいな。で、そういう IRA、401k っていうのは、年金とかじゃないけども、その、リタイア後にね、キャッシュアウトできるっていう制度だから、リタイア後のためだから、リスクをね、狭めるために大体インデックスとかね、買ってるんだよ。ビットコインを IRA で買う人はなかなか買えないと思うんだけど、今。ってことで、毎月の給与から一定額がね、ETF に投資されると。その ETF の中の一つとしてナスダック100があって、そのナスダック100の100分の1でマイクロスタチがあるわけだから、これ、毎月定額制でパッシブで、ね、お金入ってきて株価の上昇圧力が継続的になるよねっていう長期的なね、フロー。そして最後、リバランスフローは、インデックス内の銘柄の市場価値に応じて株式を再調整するプロセス。例えば、アップルをね、旧来企業で、ナスダック100の中で 8.9% のウェイトがあるんだけども、市場価値と株価が上がると、ウェイトもね、増加しちゃうよね。規模で、マーケットキャップで。だから、売られますよって、自動で売られますよってことなんだよね。マイクロストラテジーもこれがね、適用されますよってこと。つまり、爆上げした後に調整売りが勝手に入りますよってことなんだよね。そして最後にビットコインイールド将来の収益性なんだけども、ビットコインの通貨購入を続けることで株式の、ね、価値が爆大すると。去年の10月30日以降、マイクロストラテジーは購入ベースが爆速に伸びてるんだよね。これトランプ就任前と就任後ね、11月だよ。からめちゃめちゃ買ってると。でこれがね、どのようにね、将来的に収益性や適正価値に影響するのかっていうのが議論されているので、その翻訳を見てください。
Like, what is an index fund? Like, what is this NASDAQ 100 fund that MSTR is going to be added to? I mean, hopefully they'll be announced, on Friday. Well, I guess that'll be tomorrow when this comes out. For next week, they'll be added. So the index fund that we're hoping that they're getting added to is the NASDAQ 100, right? Tracks the 100 largest U.S. companies that are non-financial companies. But you also have some other really massive indexes like the S&P 500, the Dow Jones Industrial Average 30, and the Total Stock Market Index. But when it comes to index funds, it's important to know that you're not, like, if you put money into like Qqq, you're not directly investing in like the index itself. You can't invest in these indexes. What you're doing is you're putting money into funds that track the index, right? So the main fund for the NASDAQ is Qqq. The main ETF for the S&P 500 is VU, DIA, and then VTI for these other two, right? So you are putting money into an ETF that is aiming to track these index funds, right? And so when you have a company like MicroStrategy that is added to one of these index funds, there are three forms of passive flows, or three forms of flows, I should say, that are added or that come into that stock or into the pool. And so the first one is initial. So if they're added next Friday, Bloomberg estimates that there's going to be $2.1 billion worth of initial flows that come in, right? That is this fund, the Qqq, and other ETFs and other funds that track that NASDAQ 100 index, they are buying in because they need to have a certain weighting to represent the market cap of MicroStrategy, MSTR, within that index. They need to create that position of that, and that's where the initial flows come from. The second one, which
this is a one-time inclusion. These types of flows don't ever happen again.
Right. This is a one-time event, massive initial flow, and then that's over. That's done because you have that position. But once MSTR is within the index, there needs to be there's other flows that come in. So for example, the passive flows, which is what everybody loves to talk about, like these zombie passive flows from IRAs, from 401ks, these retirement accounts, people just, plowing money into the S&P 500 every month. And then that's what these passive flows are coming from. These are the bi-weekly contributions, the monthly, the 10, 15% taken out of your paycheck and put into these passive flows, right? This is a huge form of buy-side pressure on the stock. And the third one is called, they're just rebalancing flows. And typically rebalancing flows are overhyped for normal stocks. And I think it's underhyped for MicroStrategy. And that's what Dan and I want to talk about in this video, is just the difference here between MicroStrategy and another stock like Apple or Microsoft or something. So the idea is this: all else remaining equal, stocks within an index will self-organize themselves. So if you've got, and actually before I do this, let's click on this, Dan, just to explain this. So MicroStrategy, we're hoping that they're added to the NASDAQ 100 next Friday or next Monday or 2 Mondays from now, whatever it is. This is what the NASDAQ is, right? So they have a 8.9%, Apple has an 8.9% weighting in this index, right? The second one is 8.08%. That's NVIDIA, Microsoft. And as you get, down into, 40 or wherever MicroStrategy is going to be, we're talking like a 0.5% weighting. But I mean, that's still substantial. Like that's billions of dollars worth of capital flowing into the stock. And then let's see, what's the bottom one? Bottom company is 0.1%. So this is the index. It's an index of companies, tech companies, 100 largest companies in the US, minus the financial stocks.
And you can see, and this is a good illustration of the non-linearity of the weighting, right? The weighting goes from, it's exponential. This is something Jeff says a lot, but it goes from 0.1% up to 10% for the top 100 companies. And you can see that the top, whatever it is here, 10 companies make up about 20, more than that, 30, 40% of the entire weighting of the index.
Right. Yeah. It's once you get into the top 10 here, it's massive. And
right.
these top 10 companies are what move the index, right? You need the rest of the 90 companies to really have a substantial impact that outweighs the impact of these top 10, right? So when we talk about mega cap stocks driving the stock market, this is what people are talking about, right? The portfolio percentage, the weighted allocation is so large that whoever, Apple, NVIDIA, Microsoft move, that's the way that that index is going to move.
Yeah.
Okay, so if we go back to, let me switch to this. So within this index, actually, let's use this as an example. These stocks they're self-organizing, and what that means is Apple here has an 8.9% allocation, and they've got like a $3 trillion market cap. If that stock increases or appreciates by 10%, right? They have a larger market cap now. All else remaining equal, they have a larger market cap than these other companies, and so that portfolio that they should have now is 9% or 10%, right? And so people think, the rebalancing means that they need to buy more Apple. But in reality, that current allocation, that 8.9% that they have, these are just, round numbers. If they go up 10%, and I know that doesn't actually get them to 10% in the allocation, but the holdings that this index or these ETFs already hold will grow by 10%. So it's just naturally getting larger. And the same thing happens with, let's see, a stock that went down today. Adobe went down 8% today. Adobe, their weighted allocation within the index was, say, 1.6%, but it dropped 8% because the market cap went down 8%, all things remaining equal. So they are self-organizing.
10%, yeah, so if it dropped 10%, it should go down in weighting roughly 0.1%, right? Because they're 1% of the total 100%. So hand-wavy math, it's self-balancing in that way.
Yep, right, self-organizing. So people are, this idea of rebalancing is not a huge deal. It's just maintenance with the index. And obviously there are some discrepancies where you do need to buy more of a stock or sell a little bit to accurately reflect them.
Largely, this is a result of the market cap being pretty directly correlated to the share price, right? And as we're going to get into here, MicroStrategy's market cap and share price are pretty uncorrelated in the way they've been moving. So,
yes, exactly right. If you are not issuing shares or buying back shares and everything else remains equal, you do not need to rebalance within the index.
Right.
However, once you start to get into buybacks and accretive equity issuance, which we'll talk about, that's when you start to get these added these rebalancing flows that this third type of index flows. So the more successful companies will increase in value along with the proportional weighting. So no extra buying is necessary. The less successful companies will decrease in value and their proportional weighting decreases, right? This is, we're Bitcoiners. We love MSTR, but this is why index funds are so powerful for like the super passive diversifying investors, because they don't have to worry because these indexes just self-organize to an extent, right? All else remaining equal. So there's no buying or selling. So just as a super crude example of what this looks like, and we can even say that this is like Apple or Microsoft. Let's say that there are 100 shares worth $10, right? So they have a $1,000 market cap. And we also see that the QQQ, right, which is the ETF that Apple's a part of, total assets under management is also $1,000. And so company A has a 1% weighting in the QQQ. This is arbitrary for the sake of example, right? So that 1% weighting represents one share that's worth $10. So this company now grows 10% in a year. And let's just say that all else remaining equal, the QQQ, the value remains flat. Okay. So now, because the QQQ is remaining flat and company A has grown a little bit in value by 10%, the new weight that company A needs to have within that index to accurately represent the market cap for company A is 1.1%, right? So the new stock price is $11. There's still 100 shares. The new market cap has increased from 1,000 to 1,100. However, nothing needs to happen because of the self-organizing effect within an index fund. The holdings that QQQ had, it was originally worth $10. Now it's worth $11. So the new weight, without anything happening, the self-organizing effect is still 1.1%. So this is generally why when I say like people normally overemphasize rebalancing for normal stocks, this is what I'm saying. Because outside of anything else changing, this self-organizing effect makes it, neutral. Like there's no buying and no extra selling. However, when you get into share buybacks or new shares being issued, that's when this can change on a stock-to-stock basis. So all things remaining equal, the natural P&L of the stock will move the index holdings up and down to accurately represent the market cap of the company within the index. Dan, do you have anything to add to this first scenario?
No, that makes complete sense to me, and I think it's tough to wrap your head around, and there are different nuances, but all in all, on the margin, this is what's occurring and important for people to understand. Every time a stock moves a little bit in a quarter, there isn't massive buying and selling and reorganizing that occurs. It's small adjustments here and there, especially for, as you said, stocks that have a very stable number of shares.
Right. Yep. So to go to, I put out a tweet a while. Let me show that again. I put out a tweet a while back of this effect, and I was going to do this in that Google sheet, but it was a little too complicated and didn't make sense. So we're going to go to this second example, right? Company B here. And we're just going to say that company B is similar to MicroStrategy. So similar situation. They have 1,000 shares and a market cap of 1,000, right? So each share is worth $1. And they also, let's say they have a 10% stake in the S&P 500, right? This is an arbitrary example for the sake of illustration. They issue 100% more shares. So they dilute 100% of their equity, right? So they are issuing 100% of the shares outstanding. So there were 1,000 original shares and now 1,000 new shares. Okay. And so there's 2,000 total shares. So 100% dilution. So this happens in between.
Those are pretty reasonable numbers considering what we've seen over the past year.
Right. Yeah. So we're at $100 billion market cap. This is like, Saylor next earnings call issues $100 billion, ATM. But this happens in between rebalancing dates. This happens, let's say, within like 3 months. However, during that window, the market cap grew 100% to $2,000, right? But each share is still worth $1. So if you're an investor in MicroStrategy, if you're an investor in MicroStrategy, your gains are zero. You have a 0% increase on your position in this window. However, the market cap grew. And this is what Dan was saying, where like the market cap and the stock don't track perfectly because the market cap is going to increase more than the stock will because of this accretive equity issuance. So
Gotcha.
Because the market cap grew from 1,000 to 2,000, the S&P only holds 100 shares, which is now 5% of the market cap, right? But the weighting within the S&P, or with this example, needs to be 10% to accurately represent the market cap. So they are low or short a total 5% of this company because of this accretive equity issuance. And this gets even more crazy when like the stock price also goes up and this happens. But just for the sake of example of the discrepancy between stock price and market cap. So not only does MSTR dilute shareholders, but it is accretive. So there are more shares that go up in value, which causes the market cap to increase even faster. So this isn't like a one-time, like crazy, like catalyst. This is like an ongoing quarter after quarter, year after year, when funds like QQQ or VU, when MSTR is hopefully added to the S&P 500, or the Russell 1000 index, or an MSCI All Country World Index ETF, when just quarter by quarter, when these are rebalanced, these ETFs, these funds are gonna be on the bid to then gather more shares to accurately represent MSTR in that index. And the opposite is also true. If MSTR was doing buybacks, again, all else remaining equal, if they were doing buybacks, the position that fund holds would be too large compared to what they actually need to represent that market cap. So then they would be sellers. So it's kind of this weird thing where, traditionally you want your company to do stock buybacks. And MicroStrategy issued the largest at the market stock offering, equity issuance offering that we've ever seen in financial markets. And, it feels dilutive, but it is accretive. And not only is it accretive, but it adds this third form of passive flows that we're going to see in the future, where you have this extra, not only do you get passive flows from new buyers in these ETFs, you get new flows from the ETFs, these funds themselves, because they are under allocated to accurately represent that increase in market cap.
So if I understand this correctly, let's say hypothetically MicroStrategy has a 1% weighting in the NASDAQ 100 at the end of the year. Let's say they do an at-the-market equity issuance that, as in your example, doubles the number of shares outstanding, but the share price trades flat. If they had a 1% allocation in the S&P 500 and all of these conditions were met, then the S&P 500 would be short 1% of the stock upon rebalancing. So they'd have 1% of the total market cap of MSTR required buying pressure, right?
Yes, that was a hard example to follow, but I think you've got it. Yeah.
Yeah. So I guess it's just me restating this here and trying to figure out if I understand, but the 5% stake, the 10% stake. So even for a company like MSTR, which may not have a 10% stake, or the 10% stake is of the company. So I see what you're saying. Okay. Lots of buying pressure.
It's just buying pressure. And the more they, I saw a comment, and I keep talking about it. I saw a comment in Irresponsibly Long MSTR that was like, sailors ruining the stock with the ATM. And it's like, not even close. Like, he's accreting more value to the baseline of the equity, right? The balance sheet. And then over time too, they're not going to stop doing this. They're going to do this quarter after quarter after quarter, as long as some sort of premium remains. And not only are they just accreting that extra, 2x, if they issue 5% more shares and they accumulate 10% more Bitcoin, that's accretive. But also because of that stock price and market cap discrepancy, they're adding to the bid because of these ETFs and these mutual funds that are tracking these indexes will need to be buying more shares to accurately represent the market cap.
Okay.
So, and it's if we look to, let me, Dan sent this over to me. When we look at, so specifically talking about the NASDAQ, there's a slight difference between the S&P 500 and the NASDAQ 100. The S&P 500 will both reconstitute and rebalance quarterly. I believe, I could be wrong about that, but I'm pretty sure they do both quarterly, which is why,
No, you're right. You're definitely right on that.
I'm hoping that MSTR is added, if there's no shenanigans, on June 20th of 2025. That's the estimate for S&P 500 inclusion. But when it comes to reconstitution, we have one shot annually. But once you're in, this rebalancing it's amazing. It happens quarterly, right? So we're going to start to see, if they're added next week, we're going to start to see this effect even after the initial flows, even after the passive flows. We're going to see these rebalancing flows start at the end of Q1, and then they'll hit at the end of Q2 and the end of Q3. And we're already seeing this with the Russell 1000, the MSCI ACWI index, and then all the other ones that they're seeing that are market cap weighted specifically. So
okay.
And I guess to draw one more comparison, if you have like a regular, like let's say there's like a growth stock, like a tech growth ETF, and they love MicroStrategy. They have a 10% weighting in MicroStrategy, or 5, or it's a large weighting within this ETF. They are choosing that weighting based on what they think will be the best risk adjusted return for that ETF. It doesn't really matter what the market cap is. They only care about the stock price. However, once you get to these super large indexes, like the ones I've listed a bunch already, all they care about is market cap. And so that's when this accretive equity issuance just becomes this added different flywheel where they are perpetually, like literally day after day, they are lower and lower and lower on the number of shares needed to accurately represent the market cap, not the share price, the market cap within that index.
And so any increase in the share price is just leveraged by the increased number of outstanding shares, as you're saying. Right. So it's just another level.
Right. And this actually works too, even if the stock goes down. Even if the stock goes down, they're still low on shares because of this equity issuance.
So if the stock goes down 25%, but they double the number of outstanding shares, they're still getting they're still short on shares.
Yep, because the weighting is 2%, but the new market cap level requires 3% or something.
Right.
So,
gotcha.
Yeah. Do you have anything to add with, I guess, the dates or anything?
The dates are straightforward. This is straight from the NASDAQ PDF that they have about reconstitution dates. So take your information from right here, not what you read online necessarily. This is straight from the source. So if you have it, pause the video and take a look there if you're confused at all.
Mm-hmm. It's also important to note too. This is oh, never mind. This is NASDAQ. I was going to say something about Qqq. All right, you're up, Dan.
Oh, but we have that stuff too, right? We have we can link that. You sent me something about
I did. I will actually just pull this up too. So it actually
to Matt's point, the index rebalances in similar dates, but not exactly on point with the actual ETF rebalancing. And ETF rebalancing is what drives the money into these stocks based on their market cap weighting. The index itself doesn't drive the flows.
Bingo. Right. Yeah, so even if the NASDAQ 100 rebalances, what matters and where these flows come from, and let me share this too. I'll zoom in. What matters is when like these funds like the Qqq will rebalance. Okay. And you can see right here, the fund and the index are rebalanced quarterly and reconstituted annually. So it's in line with what the overall index does. But again, this is where the money is, not the overall index. This is just tracking that index.
Yeah, okay.
So...
Well, and that leads us into the most important question for S&P 500 earnings or inclusion, the post-FASB earnings. So Matt and I were just briefly going through the Bitcoin acquisition, all the Bitcoin purchases over the past few years, but then more specifically after the 21-21 plan was announced. And I think the metric we really liked was the BTC yield and how that is reflected as a P to E ratio and what that would mean for the price of the stock. So all of this is going to be included in the net income statement after FASB fair value accounting. But a key point here is that it's not retroactive. So any increase in the fair market value of MicroStrategy's Bitcoin holdings from the first day of Q1 2025 through the last day of Q1 2025 is marked as a gain on their net income statement or a loss. It's not retroactive, right? It doesn't include the markup in the documented purchase price of their Bitcoin to the fair market value of their Bitcoin. That is assigned retroactively and added to their their balance sheet in their earnings report. But these P/E ratios are for two different earnings per share calculations. So this first earnings per share calculation, and this is Q1, all the dark green is Q4 2024, and so far. And what this is the earnings per share based on the BTC yield and the price at which the BTC was purchased at. So the BTC yield is just all of the Bitcoin that have been added to the balance sheet, right? And so that you can be reasonably thought of as earnings. It's new money, new Bitcoin that's being brought into the company and then held indefinitely. But so if we use those BTC yield earnings, you get a 70 earnings per share and a 24.19 price to earnings ratio on that, which is the average S&P 500 price to earnings ratio, puts you at around $1,700 a share fair value. And then we've kind of been discussing, okay, does this slow down? And obviously this does slow down. These are some like kind of hand wavy rate of increase calculations for the trailing 2 months of Bitcoin purchasing. So you can see the rate at which Saylor is purchasing Bitcoin here is astronomically higher than it's been in the past ever. So obviously that's going to have a higher multiple or justifies a higher premium to the underlying Bitcoin holdings because they're increasing so fast. And so that's something the market's trying to determine and figure out. And obviously we haven't arrived at a fair value yet. Is there anything you want to say on that, Matt?
Yeah, I think, if you look at the 83%, 203, 400, 500, 800, that's all after October 30th. And so that's when I kind of say that MSTR has entered this new era, right? When you saw Saylor in that earnings call, they had 4 years where they were stumbling in the dark trying to figure this stuff out, and then finally over the last year or so they figured out our product market fit is securitizing Bitcoin, and they right after the presidential election they've just gone pedal to the metal. So this will slow down to an extent. However, this general rate of accumulation I think is going to continue over the next few years. The question that Dan and I were throwing around is, when this slows down, which it will inevitably do, when they have 800,000 Bitcoin and they can only add another 50,000 Bitcoin 1 year. I mean, let me just do that math real fast. What's 50 divided by 800? That's a 6.25% growth rate, or 6.2% annualized yield. At that point, what is the market valuing that increase at? Right. So if they and if the market can see that coming now, what is the discount that they're going to apply? And the answer is we don't know. Some people are too bearish on what that multiple should be. Some people are too bullish on what that multiple should be. But that's not even considering what they're going to use that Bitcoin for in the future as they start to try to monetize it, get a yield.
Exactly.
Become
but
that
ultimately,
Bitcoin bank.
Even if they monetize the Bitcoin, right, the master metric is still BTC yield. Because if they monetize the Bitcoin, they're going to get, maybe they monetize it for cash. They'll use the cash to buy the Bitcoin anyway. So it all comes down to, what do we think the BTC yield will be in 20 years based on ATMs, convertible notes, different equity issuance, and some sort of maybe lending product or other banking services, whatever it may be. It can all be boiled down to BTC yield. And I don't think BTC yield is the metric.
Yeah, and that's a metric that other companies will continue to adopt too. Like this isn't just a niche thing. This is going to continue to grow and be adopted as the new hurdle rate, basically. But we'll see. I mean, these numbers are crazy, but when you look at the average S&P 500 forward PE is 24, and most companies are growing at 7. I guess the S&P is growing at 10% a year. So if we're at a 10% Bitcoin yield, what multiple is the market going to place on that for that forward earnings? And that's the question that we're trying to figure out, because right now it's super high. What are we at? I had to we're at 70. Wait.
Yeah.
I guess the yield is, it's like 80% or 70% or whatever it is. And the question is, what multiple are we going to continue to see? Because the answer is it's going to stay high for a few years here, maybe even a decade.
I think so. Yeah.
But the question is, in the interim between they're at a Nakamoto, 1 million coins, we're in between that and then them really starting to monetize the Bitcoin. What does the market value them out that there? And the point is, they're going to continue to be this hyper growth stock for many years to come. But the question is, how does the market apply some sort of discounted Bitcoin appreciation to that?
Yeah, completely. Well, that's great. I think we should cut it there. And thanks for watching. Matt, thanks for coming on.